we get the honor and luxury of speaking to the man, myth, the legend, Mr. Greg Dickerson. How you doing, sir?
Doing fantastic, Michael. How are you today?
I'm doing very well. I've been looking forward to these conversations because it always helps me. You help me see a bigger picture, plus how everything ties together. You just have a way of putting things together that's so helpful. So thank you for being a part of this every week.
Yeah, man. It's a pleasure to be here.
Awesome. So what we talked about the tail end of episode 1 was a concept called demand destruction. And, you know, a lot of people are talking about inflation. It is obviously horrible. It's hurting the poor. It's hurting the middle class. It is really a regressive tax. But here's the deal, that the unfortunate truth, at least in my opinion, the only way that you really can crush inflation is creating what is called demand destruction. And that might be a word or a phrase that people don't know, but let's just say this: a demand destruction obviously means a recession, which means 2 negative quarters of GDP back to back. So do you kind of see it the same way, or are you out there hoping for some kind of soft landing?
Well, they want to try for a soft landing, but you just can't. There's just no way to do it at this point. I mean, they can try, but inflation's out of control. It's going to get worse. Mm-hmm. You know, the job front is strong, so they have no ammunition not to get aggressive with policy. Now, Powell has a track record of not doing the right thing. They're way behind the curve on this. They've missed the boat completely. Yeah. So unfortunately, I don't think they're going to continue to make the right call. They haven't done anything. They haven't stopped QE. They haven't stopped buying mortgage-backed securities. They've single-handedly probably destroyed the housing market as we know it. People don't realize that yet, but interest rates are up. As they continue to get higher, you're going to see fundamental changes in the housing market and values, which is wealth destruction. And the only way to contain inflation and control it, I mean, it's out of control. Companies every single day are coming out saying, wait a minute, we're going to raise prices. Our costs are up. Number one. Number two, wow, we found out we're way more profitable making less cars. So we're going to continue to make less cars so we can keep demand up and prices up. So, I mean, they're way, way, way behind the curve to where they've created behavioral changes at the corporate level, which has created behavioral changes at the consumer level. The interesting thing is demand isn't down all that much with rising rates and things like that. But people are racking up credit card debt. They're continuing to spend, continuing some habits. We're coming off the pandemic. You're going to see people traveling a lot this summer, depending on what's going on and what the real costs of that are. But people want to get out and spend some money and do some things. But inflation's real, and it's depending on the people's income level is how it's, like you said, it's affecting lower income people more than higher income people. But even higher income people are noticing it and seeing it.
Yeah, well, the fact that when Olivia actually mentions something that went up in price tells me that inflation is real. She hasn't mentioned a price, thankfully, in might be a decade. And she's been mentioning a couple of things as we go to the grocery store going, how much was that? And let's just say that's not normal. So I know it's out of control. The other thing, I don't know if you saw this morning, Goldman Sachs came out this morning. It might have been last night. I read it this morning. They're now calling for 12 successive quarter rate moves, kind of like Bernanke, right? Just a quarter point every meeting, you can count on it, i.e. guiding Wall Street to what's coming. But
in what country is that they're talking about?
The U.S.
What country is that they're talking about?
Yeah, exactly.
Is there? I don't know that there's anybody in this country on the Federal Reserve Board that, I mean, they haven't done anything yet.
I know, but I was just trying to play this out. So and again, 12 meetings means we go into 2023 because there's only 7 meetings left. So if we got there, it's like 18 months from now because they don't meet every month. So let's say the Fed funds rate is 3%. I don't think it gets there, but let's just say Goldman is right. If Fed funds rate's 3%, that means the 2 years got to be what? 4.5, 4 3/4?
Maybe, yeah.
I mean, higher, right? It's not going to be lower. That means probably what, 30-year mortgages for owners, 5 3/4, 6%. I mean, could you imagine? I mean, 6% is the number that you and I go, transactions stop. Talk about demand destruction. Wow.
Yeah. Even though it's still a good rate, even 5% is still a good rate. But the problem is where we're coming from, and they're going to have to make a decision. Do we destroy the markets and values of real estate, not just residential, but commercial? all over the country, which reverberates all around the world. You know, a lot of people don't realize that is the number one asset class from a valuation standpoint by far, more than all of the others combined.
Wow.
Real estate around the world is a higher market cap than every other asset class combined by, I don't know, 2 or 3 fold, hundreds of trillions of dollars. And when you start messing around with interest rates, it affects the values of commercial residential property. So, I mean, 6 rate hikes, who knows if they hike 10 basis points, 20, you know, I mean, it depends on how much they're hiking.
Yeah.
So that statement really means nothing.
Yeah.
And the Fed, as they go along, all we know is what we've seen in the past, 2017, 2018, 2014, anytime they've tried to hike rates, the markets capitulate and the Fed has to come back in and rescue markets. The question is, are they going to do that? Are they going to rescue the consumer, or are they going to rescue the markets? And unfortunately, they're kind of both tied together, because everybody's wealth now is tied up in this stock portfolio. It's tied up in real estate of general, not everybody, but, you know, the investors, people that own houses and people that are investing in the markets. That's a lot of wealth destruction. So you talk about demand destruction, you start messing with people's wealth, you know, demand destruction will take care of itself.
Well, no, exactly. And you know, if you want to understand what's going on, just look at what happened in Russia. This could happen here, right? I mean, Russia citizens in the last week or so have seen the stock market fall off a cliff, their ruble collapse. Not saying that's happening here, but that's just the example of wealth destruction leading to consumer behavior change, leading to this. And it's one of the reasons in commercial real estate, I think residential withstands the market better, because again, 30-year fixed rate debt, you don't have to move. But commercial, you and I both know, commercial debt structures, they have reset periods, reevaluation. You go into that environment and your next interest rate 6% versus 2.5%. Man, your cap rates are different. Your NOI is different. It gets pretty ugly pretty quick, I think.
Yeah, it's an interesting situation that we're in, and the Fed has to do something. Central banks around the world have to do something now. The current situation, the current environment is throwing a little bit of a wrench in that, but we'll see. We're going to know this week, Wednesday and Thursday, exactly what Powell thinks
he talks
about
twice.
the situation and what he'll telegraph what they're going to do, because the meeting's coming up in 2 weeks.
You're right.
Where they're going to make a decision. We're going to have a CPI print. Guarantee you it's going to be out of control again.
Wow. Yeah. It's
they got to take some kind of action. They can't just keep doing what they're doing. Although we've said that how many meetings now? Last year?
Yeah, exactly. At least the last 6 meetings. Yeah, exactly.
Yeah.
Yeah. So again, folks, I've said for quite a while now that I think a recession is in the offering. And it's pretty much because we've got to nip inflation in the bud. And frankly, the fastest way to do that is demand destruction. Demand destruction means lower GDP.
That's the only way to do it, because the labor market's strong. There's more jobs than people willing to take them. Manufacturers and companies, again, they've figured out, wow, we can be way more profitable by raising prices and cutting back on how much we're doing. So they're getting it. So it's an interesting situation where we're at right now. And recession isn't necessarily like this huge bad thing. It's like you said, it's negative growth for a couple of quarters. That can be negative 1%. The real question is, how are you really measuring that, and what's the real effects of it? But inflation is a huge, huge tax, and it eventually will change course. It will change the course of demand and jobs and production all on its own. At some point, people just push back and they stop spending because they just can't afford it. There's only so much, and if credit tightens up, as rates rise, credit tightens up, it becomes more prohibitive and difficult to get. And then that's just your trickle down effect. And then you get the borderline recession depression, kind of like we were facing in 2009. Yeah. So we haven't faced a situation like that. Most of the investors out there, millennials, haven't seen what that looks like. Mm-hmm. So, it's a delicate balance. And so far they've kind of ignored it. It's really interesting.
Yeah, it is on their doorsteps. My hope, again, I feel less good about this call. My hope is still on March 16th, they announced a 50 basis point cut. I think they've had to shock the system for a while. I think the market expects a quarter. I think they need to do a half. And if they do anything less than a half, it's not going to do anything, in my opinion.
Yeah. And, like you said, we talked about it last week. This is an opportunity for the Fed to unload the balance sheet. They can sell some treasuries at a pretty attractive number right now that works for and finance some debt, finance some spending. I mean, they could probably issue new notes around the world right now and very attractive rates versus down the road. So it'll be interesting to see how Treasury responds to this environment right now. And if they choose to do that to fund things, efforts around the world right now.
Yeah. Yeah. Back to that point, I think one of the things the Fed has at the doorstep is they've been given the opportunity to unload $1 trillion or $2 from their balance sheet, and the market wouldn't even notice. The thing that I've been most afraid about is them unloading into an unstable market where rates shoot even higher. Right now, everybody wants the dollar. So Jerome Powell, if you're listening, sell some treasuries. Greg, how can people find you?
GregDickerson.com. All my info is there. YouTube channel, podcast. Go check it out. GregDickerson.com.
Thanks, buddy.